Hello everyone. I would like to welcome you all to the online session of financial statement analysis. This is our lecture number 3 on analyzing investing activities, chapter number 4. In our previous lecture, we discussed about the current assets, and in the current assets, we discussed in detail about cash, receivables, and prepaid expenses. Then we discussed inventories and inventory valuation. In inventory valuation, we discussed different types of valuation techniques and their impact on the income statement and balance sheet. Today, our focus will be long-term assets. In today's lecture, we will be discussing capitalization. Then we will be discussing 5 different methods to calculate depreciation. And then we will shift to the intangible assets. So let's start today's session. First of all, the long-term assets, or we also call them non-current assets. So long-term assets, as you guys already know, have a life of more than a year. These are the resources that are used to generate revenues. These long-term assets are basically of 2 types. They are tangible, they are intangible. Tangible assets are all those which we can touch, like property, plant, and equipment. On the other side, intangible assets, as you guys already know, are patents, trademarks, copyright, and goodwill. These long-term assets, usually their cost is very high. So we, as you guys already know, we capitalize their cost. We don't write their cost in the income statement. So when we capitalize their cost, it means that when we are going to write their total cost in the balance sheet, then we have to expense out some part of it every year. So these costs are basically deferred and are deferred, or in other words, we can say we will capitalize them. So the process of deferring a cost that is incurred in the current period and whose benefits are expected to extend to one or more future period is called capitalization. And capitalization, as I already discussed you, will be on the tangible assets or intangible assets. You can also say tangible assets are also hard assets. On the other side, there are some soft assets. So soft assets, we will put them as research and development, advertisement, and wage cost. These are our soft assets. Now the thing is, when we should record an asset, or when we should record the cost in the balance sheet, or when should we capitalize the cost? In order to capitalize the cost of any asset, the asset must need to meet the following criteria. The first is, it must arise from a past transaction or event. It must yield identifiable and reasonably probable future benefits. We need to know that what benefits we are going to get from this asset, and it must allow owner control over future benefits. We need to have a control over the asset, which means that we can decide how much we can use the asset in a year. We can use the asset, we can produce 50,000 units, 60,000 units, 70,000 units. It is under our control. So once these 3 criteria meet, then we can record the cost of the asset in the balance sheet, or we can say that we can capitalize the cost. This capitalization of the cost have an effect on our income statement and balance sheet. First of all, capitalization is important because when we capitalize the cost, the main idea is that we are postponing the revenue, we are postponing the recognition of expenses in the income statement. We are not recording all the expenses in the income statement when we are going to buy this property, plant, and equipment, or in other words, these long-term assets. So if we are not going to record these expenses in our income statement, then it ultimately means that we are heading towards, or we are looking towards a smoother income curve. Because if we are going to write huge expenses in 1 year, if we buy a property, plant and equipment, then ultimately our net income will be showing too much volatility. So this is the first and the foremost important thing, uh, the reason why we use capitalization. When we will capitalize any cost, then it is going to have an impact on our return on investment. All the ratios, mostly return on investment will be affected, our solvency ratios will be affected, our operating cash flows will be affected. All of these, where we have the income, or where we have the investment or shareholders equity, or where we have an equity, in all the formulas where we have these three four things, then these are going to be affected in one way or another way. So if we talk about return on investment, then capitalization basically decreases volatility, as we already discussed, in income, which affect both the income, which is our in our numerator, and investment, which is our in our denominator. If we look at the solvency ratios, let me share with you the solvency ratios. If we look at the solvency ratios, these are our solvency ratios. So if we look at these solvency ratios, you can see shareholders equity, we have EBIT. So it is going to have an impact on all these ratios in one way or another way, because the net income from the income statement is going to end up in the shareholders equity, because shareholders equity is accumulation, is a sum of the total shareholder capital plus the retained earnings. So it's going to have an impact on all these ratios in one way or another way. So that's why we need to see the effect of capitalization on our financial ratios, and on our statement of financial position and statement of financial performance. So these are the effects of capitalization. When we are going to record it as an expense, slowly we are going to record it as an expense. After this, these effects of capitalization, we are heading towards the allocation, how to record or how to take out a small portion of the expense from the balance sheet and put it in the income statement. Allocation refers to the process of periodically expensing a deferred cost to one or more future expected benefit periods, determined by the benefit period, salvage value, and allocation method. The cost allocation is the process to match asset cost with its benefits, which means that if we are going to use the asset in this year to produce 60,000 units, then we need to calculate the wear and tear on this asset. We need to calculate that this property, plant, or equipment which we used to prepare this 60,000 units, how much cost we can put it in the income statement, as how much expense we can put it in the income statement, and how can we reduce the balance of the long-term asset in the balance sheet. So we basically this there are these allocation methods are is also called depreciation. So we are going to calculate over here depreciation, and depreciation is basically calculated on the fixed asset. Then we will also amortization. Also, amortization is also an allocation process, but amortization is calculated on the intangible assets. Then depletion is calculated on the natural resources. And in order to calculate these, in order to allocate the cost uh, to the income statement, we need to have complete idea, or we need to have the information about the useful life of the asset, long-term asset. We need to have idea about the salvage value, the residual value, or the trade-in value of the asset, and the allocation method, which means that we need to know that the company is using which type of method to allocate the expenses in every period in the income statement. Now let's try to go before calculating it. We need to have a little bit idea about impairment. You guys already have discussed, we have already discussed this idea in the class. Impairment is the process of writing down the value of asset when its expected cash flows are less than its carrying book value. So this is impairment. The effect is to reduce the carrying amount of the asset on the balance sheet and to reduce the profitability, because we are going to put it in the income statement as an expense. So if you remember, uh, as we calculated it as unrealized gains and losses. So these impairment are basically going to have two kind of distortion, is going to create two different types of distortion for us. These distortions are conservatism bias and large transitory effects. So first of all, conservatism bias, we always, when we calculate impairment according to conservatism principle, then we always write down the value of asset. We don't write up the value of asset. So it creates a conservatism biasness, that why we always write down the value of asset rather than writing up the value. Second is large transitory effect from the recognizing asset impairment. It basically affects our net income when we are going to, whenever we are going to calculate the impairment as an expense or as an impairment loss, then our net income will be undervalued. This, after this impairment concept, let's head towards the property, plant and equipment. Plant and asset and natural resources, these are tangible assets. These are actively used in operations and expected to provide the benefit in the upcoming years for the company. Mostly we call them property, plant and equipment. In order to calculate the in order to record the value of this property, plant and equipment in our books of accounts or in the balance sheet, we need to calculate the cost. And the cost of these property, plant and equipment is the sum of the purchase price plus all those costs which incur to make the asset ready for use. For example, if we are buying any asset, we need to pay the delivery charges, we need to pay the installation charges. So when we purchase the asset, the cost price, the purchase price, plus the delivery charges, plus the installation charges, plus any other charges which we incur to make the asset ready for use. So this is the total cost of the asset, and this cost we usually record it in the balance sheet. Now, after calculating the cost of the asset, we, by the way, calculating the cost of the asset, the valuation, let's try to read it from this slide. The valuation emphasizes objectivity of the historical cost, the conservatism principle, and accounting for the money invested, which means that according to the historical cost basis, we are going to record the asset at the price at which we purchased it. What are the limitation of the historical cost basis? Historical cost basis balance sheet do not purports to reflect the market value. We are not, if we are going to follow the historical cost basis. By the way, you guys already know that historical cost basis or the fair value basis at the time when we are purchasing the asset is the same. But when, if we are going to use, as we already discussed, that most of the time we use the historical cost basis for the long-term assets. So if we are going to use historical cost basis, then we are going to keep on recording the value of the asset in our balance sheet at its cost rather than the market value. This is one limitation. The second limitation, not especially relevant in assessing replacement value. The historical cost basis is not going to help us if we want to calculate or the assessing the replacement value. If we want to calculate the value to replace our asset, not comparable across companies. Absolutely right. We cannot compare the cost if we are using historical cost basis because might be we are buying a property plant equipment this year and the other companies, our competitors are buying the or already bought the plant 10 years earlier, so we cannot compare our cost for the plant today with the cost which they incurred 10 years before. So they are not comparable, not particularly useful in measuring opportunity cost. And then comes the collection of expenditure reflecting different purchasing powers. So these are some of the limitations of the historical cost basis when we are going to value them. Next comes the depreciation. Depreciation, from its definition, is very clear that depreciation is basically the process of allocating the cost of the plant asset to expense in the accounting period benefiting from its use. Depreciation expense is an estimated amount of benefit which we receive from the plant when we use it and put it in the current year's income statement. In order to calculate the depreciation, we need to have, or you can see over here, a small, that what we are doing basically, we are recording the cost of the plant in our balance sheet as acquisition cost. And when we are going to record it in our balance sheet, the cost, we are not using the plant, or we haven't used the plant for its useful life, but we are recording it as our asset in the balance sheet. Slowly we are going to take out the cost and put it in the income statement, and the amount which we are going to take out from the balance sheet is equal to the amount we used the asset in a particular year. So systematic allocation of the cost of the plant over its useful life is called depreciation. In depreciation, whenever we want to calculate the depreciation, we need to have idea about these 3-4 things before calculating. First is the cost. The cost again involves the purchase price plus all the expenses which we incur to make the asset available for use. Second, the salvage value, or we also call it residual value, or it is also known as trade-in value. So the salvage value is the value at the end of the useful life of the asset. The scrap value, we can also say. Third is the useful life of the asset. Useful life of the asset can be in the number of years. Useful life of the asset can be in terms of total units of production. Useful life can be can be with reference to total number of working hours of machine. And then comes the depreciation method. Depreciation method varies from company to company, from asset to asset, from business to business, or from industry to industry. So depreciation method. But again, if the company chooses a specific depreciation method, they have to stick with that method for the sake of consistency. The company cannot change the depreciation method from one year to another year. So these things are very important in order to calculate the depreciation. So let's try to calculate or let's try to use an example to understand different type of depreciation methods and how they are going to have an impact on our income statement and balance sheet. So first of all, I will start with the I will start with this example. Yes, please. This is the example which have been given to you, uploaded on the Blackboard. So a company purchases a factory machine at a cost of 18,000. The cost is $18,000. On 2019, the company expects the machine to have the residual value. So the residual value is 2,000 at the end of useful life, which is our N is 4 years. During its useful life, the machine is expected to be used for, this is the total number of working hours. So the total number of working hours for this machine is 160,000. And this company is using this machine in 2016. They are using it for 40,000. In 2017, they are using it 60,000. 2018, 35,000, and 2019, 25,000. So the company is using this machine according to this schedule. We are required to calculate depreciation using these 4-5 different methods for this company. Let's try to analyze, or let's try to do this example on the Excel sheet. So this is our Excel sheet. Let's try to do this example. First of all, the straight line method. In this straight line method, first of all, we need to calculate the depreciable amount. In order to calculate the depreciable amount, we have this formula. This is depreciable amount. So in order to calculate depreciable amount, the cost minus the scrap value. So the cost minus scrap value over here, the cost is 18,000. So 18,000 minus scrap value, which is our, so let's write it over here. So depreciable amount for us will be equal to 18,000 minus 2,000. So 16,000 is our depreciable amount. This depreciable amount we will write in the first column of our schedule. In the schedule, you can see this is the straight line method. In the straight line method, the first part is the computation part. The second part is the expense, which we are going to record in our income statement. The third part is end of year balance. This part is going to be going to have an impact on our balance sheet. So these are the three main parts which we have divided our schedule in. So the 16,000 which we just calculated over here, we have written this 16,000 over here. So 16,000 is our depreciable amount. Now the problem comes that we need to calculate the depreciation rate. We have discussed this many times that the depreciable rate for the straight line method is 1 over useful life times 100. So in this situation, if you remember the example, please do keep the example in front of you so that you can put it, you can put the values quickly. So for this example, our number of years is equal to 4. So if we put in this formula, 1 over 4 times 100, then our rate comes out to be 25%. This is our rate. Let me make it visible to you guys. So 25%. So 25% we have written over here. Now, how to calculate the depreciation expense? We can easily calculate depreciation expense by simply multiplying these two things. So we can multiply it over here, 16,000 times this depreciation rate, so equals 4,000. This is our expense, depreciation expense for this year, which means that when we are going to buy this machine, we are going to record this machine in our capitalizing the cost of the machine in our balance sheet at 16,000. And in year number 1, we will take out 4,000 from this 16,000, or this 4,000 from our 18,000, which is our total cost, and going to record it in the balance sheet. So this comes over here. This is annual depreciation for this year only, 2016. Next, we will calculate accumulated depreciation. Accumulated depreciation is the accumulated or the sum of all the previous year's depreciation. So this is our year number 1, which means that the previous years, there are no amount of the previous year. So over here, the same amount comes over here also. So 4,000. After calculating this 4,000, we need to calculate the net book value. In order to calculate the net book value, we will use the actual cost, not this 16,000 which we have taken over here. We will use the actual cost, and the actual cost of this machine or this plant was 18,000. So 18,000 minus the accumulated depreciation. So we will write over here is equal to 18,000, which is our cost, minus accumulated depreciation, and close it. And you will see that we are reporting in our balance sheet net book value of the asset at 14,000. Next year, when we need to calculate the same amount, we will calculate not on 14,000, we will calculate on 16,000. That is why we call it the straight line method. Again, in the straight line method, this rate remains the same for all the years. Rate totally remains the same. So again, if we want to calculate the depreciation amount or depreciation expense for this year, we will simply do the same process which we did earlier. Depreciable amount times the depreciation rate. It is going to give us 4,000. So you can see that in all the years we are calculating depreciation 4,000. So next, accumulated depreciation. Accumulated depreciation is last year's depreciation plus this year's depreciation. So if we make a small arrow over here, it will be very helpful for us. If we make a small arrow over here, so the arrow is something like this. These two things yes, please. We are going to add these two, this 4,000 for the last year depreciation and the depreciation this year. So 4,000 plus this 4,000, it is going to give us a total amount of 8,000. So this plus this amount is total going to give us 8,000. So this is how we are going to calculate accumulated depreciation. So if we want to make it over here also another arrow in order to illustrate these things. So you can see we can make this arrow like this. So this is how we calculate this 8,000. After calculating this 8,000, we need to calculate again the net book value. And in order to calculate net book value, we will again subtract the total cost. We will subtract this 8,000, the accumulated depreciation, from the total cost. So you can see over here, let's write over here the comment. So over here is equal to 18,000, which is our total cost, minus our 8,000, which is our accumulated depreciation. So this is going to be our depreciation, the net book value of the asset in the second year. So over here, we are going to write 10,000. 10,000. After this, again for 2018, we are again going to start with 16,000. Again, we will calculate 25% of 16,000, which is going to be 4,000. This 4,000 will be added into the accumulated depreciation of the last year. So this 8,000 plus 4,000 is 12,000. This 12,000 is going to be subtracted from 18,000. So 18,000 minus 12,000 is 6,000. Again, we will go for the next year, 16,000. So 16,000. We are going to calculate 25% of 16,000, which is going to be 4,000. Again, 4,000 is added up into accumulated depreciation. So 12 plus 4 is 16,000. And at the end, you will see we have nothing at the end. Or in other words, you can see that we are going to have 2,000 at the end. Why 2,000? Because we are keep on subtracting 18,000, the accumulated depreciation from 18,000. So this is straight line method. Why we call it straight line method? Because when we are going to plot a graph of straight line method, let's try to plot a graph over here. So 2017, 2018, 2019. And then let's put the depreciation expense for each year, which is 4,000. If we, you can see our graph is being developed on the top. So if we write over here, it makes a straight line. That is why we also call it straight line method to calculate the depreciation. So this is our straight line method, one way to calculate or to allocate the cost of the total or the non-current asset to our income statement. The second method which we are going to go to is reducing balance method. Again, you can see that I am using exactly the same uh, table so that you don't get confused. But when we are using this table, our depreciable amount in different cases will differ. In the straight line method, we started with 16,000 as our depreciable amount. But in the reducing balance method, we are starting with 18,000. Now, in this case, when we are going to calculate the depreciation rate, the formula to calculate depreciation rate is given to us over here. It is 1 minus nth root of scrap value. This S represents scrap value, and this C represents the cost. So the formula becomes something like this. Depreciation, rate of depreciation is equal to 1 minus nth uh, root of scrap value over cost times 100. So if we put the values over here, let's try to copy this whole part and let's try to put in the values so that we can have a better understanding of these things. So if we put this over here, let's try to put in the values. Okay, it's going over there someplace. Yes, please. So scrap value, let's put in the scrap value. Yes, please. Let's put in the values. This becomes 4 because n number of years for us is 4. The scrap value, you can write over here, scrap value is 2,000. Our cost of this plant is 18,000. And we are simply going to calculate the rate of depreciation. When we are going to calculate the rate of depreciation, then the rate of depreciation for us is going to become 42.26%. This is our rate of depreciation. Let's try to change this so that we can review. Yes, please. So this is our depreciation rate. Now, this depreciation rate will again remain the same for all the years. This is going to remain the same for all the years. Now, again, totally the same process. In order to calculate the annual depreciation expense, we will simply multiply the depreciable amount by the depreciation rate, and it is going to give us the answer of depreciation of each year. This is our depreciation each year. And this is our expense in the income statement. In order to calculate accumulated depreciation, again, because this value is, before this we don't have any value. So this value again comes over here, exactly the same value. Now we need to calculate the net book value. The net book value in this case is the depreciable amount, which is 18,000. Our first value 18,000 minus the accumulated depreciation. So 18,000, let's try to do it. I already done it over here. So 18,000, let's find the value 18,000 minus this accumulated depreciation. You can see 10,339. Now, in the next year, this closing balance will become our opening balance. So this closing balance, we can easily write it like this, is our opening balance. This comes over here. We are going to calculate again 42% of 10,339. So very simple. We can use this, or let's try to put the equation again. So this value times the rate is our depreciation expense. This depreciation expense will be added into accumulated depreciation. So we are going to do it like this amount plus this amount is going to become our depreciation, accumulated depreciation. In order to calculate net book value for 2017, we can do two things. We can either subtract this 11,999 from 18,000. If we don't like to do this thing, then we can do this thing also. We can subtract this 4,392 from the last value, from this last value 10,399. Both will give us the same answer. So let's try to calculate both of them one by one to see that they are going to give us the same answer or not. So over here is equal to, let's try to do this thing, 18,000 minus this accumulated depreciation. You can see it is giving us 6,001. Let's try to check that the other method is going to give us the same answer. So this value minus the current year, or rather than picking this value, let's pick this value. This value, both are value are same, so it doesn't matter which value you are going to pick. So this value minus the annual depreciation, you can see it is giving me totally the same answer. It depends upon you, whatever you like to do. You can subtract 18,000 from you can subtract 10,399 from 18,000, or you can subtract 4,392 from 10,393. Both are giving you same answer, 6,001. So after this, we are going to write this closing balance as our opening balance. So I am simply going to make it equal. So we are writing the same value over there. Now, in order to calculate the depreciation, again, the method remains the same. The depreciable amount times the depreciation rate. So you are going to get this amount. This amount, then you are going to simply add it in the accumulated depreciation. So this amount plus this amount is your depreciation, accumulated depreciation. And what is our net book value? Let's try to stick with this method. Let's try to use 18,000. So 18,000 minus the accumulated depreciation, 3,465. This is my closing balance. It becomes my opening balance again. So I am simply going to write it over there. This is my opening balance. Again, in order to calculate the depreciation expense, we are simply going to multiply this amount by this amount. It is going to give us the depreciation expense. Next, our accumulated depreciation. You guys already know accumulated depreciation is sum of all the depreciation. So this amount plus this amount, it is going to give us. So you can see over here, this amount is becoming exactly the same, 16,000. So in order to calculate the last amount, we are using the simple formula, 18,000 minus accumulated depreciation. You can see 2,000, which is our scrap value at the end. This method at the end will give us the scrap value because of the formula which we are using. Automatically, the scrap value will be at the end. Why we call it the reducing balance method? Let's try to understand it. Why we call it reducing balance method? So let's try to put different years over here, and let's try to put the depreciation annual expense over here. So expense over here. If we see, you can see the graph over here. The graph is decreasing from 2016, 17, 18, and 19. Graph is decreasing. So in the first year, we are calculating, we are using 7,000 as annual depreciation, which means in our first year, we are reporting huge expenses. Due to these huge expenses, if we use a reducing balance method, then it is going to have a big impact on our net income. Our net income will be understated. As we go along different years, so 17, 18, and 19, you can see in 2019, our 2019, our annual depreciation expense is reported to be only 1,464, which means that in the earlier years of the reducing balance method, we are understating our profits, but in the later years, we are overstating our profit. So this is called reducing balance. Next is called double declining method. Double declining method is very easy method. In double declining method, we are going to use exactly the same process. But in double declining method, we are going to use, let me shift to double declining method. We call it declining balance method or double declining method. Let's double declining method. So we call it double declining method. In your book, it is referring to double declining method. So double declining method, we are again going to start because it is declining method also. So it is a little bit similar to that of the reducing balance method. But the only difference is in the reducing balance method, we were using this formula to calculate the depreciation rate. But in the double declining method, we are going to use the simple formula for the straight line method to calculate the depreciation rate. So this is the formula 1 over useful life. The useful life of this machine or this plant is 4 years. So 1 divided by 4 is going to give us 25%. 25% times 2. This is why it is called double declining method, because we are doubling the amount of depreciation. So we will start this method by 18,000, exactly the same schedule. We are not changing the schedule so that you are not getting confused of different schedules. So 18,000, if we use the depreciation rate, the formula which is in front of you, if we use this formula, then the depreciation rate comes out to be 50%. Let's again change it to numbers. So you can see 50%. Now, simple for the annual depreciation, again, totally the same method. In order to calculate depreciation expense for a year, simply multiply the two values and it is going to give us the depreciation expense for this year. So depreciation expense for this year is 9,000. Ultimately, before this, there is no depreciation. So 9,000 will be the same amount in the accumulated depreciation. Now we need to calculate the net book value. So net book value is simply 18,000, which is our cost, which you can see over here in the first cell of 2016. So 18,000 minus 9,000. So simply we are going to put like this: 18,000 minus this amount, it is going to give us 9,000. Now, because it is called double declining method, why it is called declining method? Because the balance is declining like the reducing balance method. So it means that next year when we are going to calculate the depreciation, we are not going to calculate depreciation of 18,000, rather we are going to calculate depreciation on this 9,000 or the last balance or this balance. So 9,000, you can see now we are reducing the depreciable amount. Again, the percentage of depreciation, rate of depreciation will totally remain the same. So 50%. So 50% if we calculate for 9,000, so we can simply put the same formula over here. So we can drag it over here, 4,500. Let me change the format a little bit. So let's try to yes, please. Yes. Now 4,500. Now accumulated depreciation will be again 9,000 plus 4,500. So we are going to write over here. I'm simply using the same method, same way to calculate as we did in the last. Only difference between these method is the way to calculate the rate of depreciation. So 13,500. Next, we need to calculate the net book value. So in order to calculate the net book value, we will use 18,000, the initial amount 18,000 minus the accumulated depreciation. If you don't like to do this, you can do the other way. The other way is simply take the opening balance minus the current depreciation expense. So you can see both answers are same. So it depends upon you, whatever you like to do. So I am sticking with the initial amount minus the accumulated depreciation. This year's net book value closing balance will become next year's opening balance. So again, we are going to write over here the same amount. We are going to calculate 50% of this. So 50% of this is simply, or in other words, let's try to drag this down. So 2,250. Okay. After calculating this, we need to add it into the previous balance in order to calculate the accumulated depreciation. So very easily we will do this plus this year's expense is our, sorry, we have addition. This is addition. So 15,750. Again, in order to calculate the net book value, simple as that, 18,000 our cost minus the accumulated depreciation. This becomes our 2,250. In this double declining method, you can see that our value of the, or our expense or the value of the machine is decreasing very quickly. So if we want to calculate 2017, 2018, 2019, so over here we are recording 9,000, then we are recording 4,500, then we are recording 2,250. You can see the graph which is formed in front of you, that we are decreasing the value of the asset in our books very quickly. We started this question by the value of the cost 18,000, and we know at the end of the useful life the value must be 2,000. Always remember, if we start the question, if we start the schedule by 18,000, which is the cost, at the end we should receive 2,000. If we start this question by 16,000, then it should come out to be over here 0. But please try to start the same way, which like what I am doing, because if you are going to start it over here with the 16,000, then it is going to have a different depreciation expense in each year. So this is the method. So try to stick with the method which we are discussing over here. So you can see the difference between these two values. The difference between these two values is only 200 and 250. So in the last year, we are only going to record 250 as our depreciation expense, and our accumulated depreciation will be recorded at 16,000, and this opening balance will come up over here. Closing balance, same, this closing balance will become our opening balance. Rather than applying 50%, we cannot apply 50% now, because if we apply 50%, it will be having 1,125. So rather than doing this, we are simply because we need to report 2,000 at the end. We need to report 2,000 at the end. So that is why we are not calculating 50%. So I will remove it over here. We are not calculating 50% over here. I hope so that you are understanding the concept. So this is double declining method. Another way, and you can see over here in all the methods, we are calculating depreciation amounts different. These amounts are different. You can see reducing balance method, amounts are different. You can see straight line method, amounts are different. Straight line method is used basically on those machines, those plants where we expect that these property, plant or equipment are going to be used every year by a same percentage. The reducing balance method is basically used on those property, plant and equipment where we feel that we are going to use these property, plant and equipment more in the earlier part of the useful life of the asset, and we are going to use less these machines, property, plant and equipment at the or the later years of the useful life of the asset. So this is reducing balance method. By the way, reducing balance method is also used because most of the time the companies, they feel that when we purchase the new asset can produce more goods and services rather than later stages of the asset. So that's why sometimes the reason of using reducing balance method is that the new property, plant and equipment, they produce more goods and services because they are new machines or new plant or equipment. But as the plant, equipment or machine becomes old, they cannot they are not that much efficient, so they cannot produce up to those much amount of units. So these are the methods. Next comes sum of year digit method. Sum of year digit method is a totally different method. Most of the time the companies they don't use it. It's used very in very rare cases. So the sum of year digit method is, you can see the formula to calculate the depreciable amount. The formula to calculate the depreciable amount is original cost minus scrap value. So original cost in this our situation is 18,000. So 18,000 minus the scrap value is 2,000. So 18,000 minus 2,000 is 6,000. Now the problem comes in the depreciation rate. In this method assumes that because the life of this machine is 4 years, when we buy it, we will write it over here that now the life of the machine is 4 years. After using the machine for 1 year, the life of the machine becomes in 2017 will the rest of the life of the machine will be 3 years, then 2 years, then in 2019 this is the last year we are going to use the machine. So in sum of year digit method, what actually we are going to do, we are going to add up all these values, sum. We are going to add up all these values. So sum of all these values, it is going to give us 10. So let's change the format. So 10. Now we need to calculate the rate. What we are going to do, we are going to divide this 4 by the total number of the total digit which come over here. That is why it is called sum of year digit method. That we are summing up number of years. We are taking these years as numbers. So 4 plus 3, 7 plus 2, 9 plus 1 is 10. So now what we are going to do, we need to calculate this rate. So we can calculate this rate like this, is equal to 4 divided by the total number 10. So when we divide it, it will become 0.4. Let me change the format so that we can see. So you can see 4. Now for the next year, we are exactly going to do the same thing. 3 divided by this amount. Oh, sorry, this is 10. So 3 divided by 10. Next 2, again we are going to divide it by 10. Again 1, we are exactly going to do the same thing, divided by 10. So these are the rates. In this method, we are going to calculate the rates like this. Rest of the process totally remains the same. So in order to calculate annual depreciation expense, we are simply going to multiply the depreciable amount times the depreciation rate, 6,400. Next, accumulated depreciation, because there is no value before it, so it will be the same amount. Then we need to calculate the net book value. So the net book value is 16,000 minus the accumulated depreciation. So let's write 16,000 minus the accumulated depreciation. So it gives us 9,600. Now in this method, we will not take this closing balance to the next year's opening balance. Rather than we are going to use the same 16,000 for all the years. We are going to use the same 16,000 for all the years. So 16,000 again, the formula remains the same. So let's do this. It is going to be calculating, it will give us 4,800. In order to calculate accumulated depreciation, very simple. We are going to add up the two values, this value plus this value, 11,200. In order to calculate net book value, very again simple. Take the initial value or whatever value there is, because all values are same, minus the accumulated depreciation. It will give us the last value. Again, for the next year, we will do the same process. We are going to multiply 16,000 by the rate. It is going to give us 3,200. 3,200 will be added into the accumulated depreciation. So it will be this amount plus this amount, 14,400. In order to calculate the net book value, so net book value will be the 16,000. You can take this or you can take this, whatever you like. 16,000 minus 14,400, 16,000. And last year we are going to calculate 10% of this. You can see that only 16,000 left. So if we calculate this value again, 1,600. So 1,600 will be added into 14,400. So it will be equal to 16,000 itself. So this amount plus this amount is going to be 16,000. So 16,000 minus the initial amount, it is going to give us 0. Why it is giving us 0? Because we started the question with 16. And in this case, we will start the question with the depreciable amount, not the cost itself. So in this way, you can see that we are calculating or recording the expense and the value of the asset, net book value of the asset in our balance sheet. So this is sum of year digit method. The last method is activity method. In the activity method, we said that the again you can see in the activity method, the schedule is in front of you, the totally the same schedule. Again, the difference is in the formula to calculate the depreciation rate. This is the formula to calculate depreciation rate for the unit of activity method. So in the unit of activity method, first of all, we need to know, you can see by the way, this is exactly the same formula which we used in the straight line method. But over here, we are not using the useful life in years, we are using the useful life in hours. So in this question, they have given us useful life of this property, plant and equipment. Total useful life is 160,000. This is the useful life of the property, plant and equipment. So what we are going to do, original cost was 18,000. 18,000 minus the salvage value. So 18,000 minus salvage value 2,000 is 16,000. 16,000 divided by the total useful life in hour, which is 160,000, multiplied by 100. It is going to give us the depreciation rate. So depreciation rate comes out to be 10%. So it comes out to be 10%. So if we convert it into percentage, it will be very nice also. So 10%. Yes, please. Or let's move it or finish it like this. So 10%. Now we need to calculate the depreciation amount. So simply the method remains the same. So this times the 10%, it's going to give us, this is 10%. So let's try to calculate the percentage. So so 4,000. So in this way, we are going to do it for all the years. Again, if you see or look at the example which I have already uploaded, number of different units of activity is given. So in the first year in 2016, the company is going to use this machine for 40,000 units. Next year, the company is going to use this machine for 60,000 units. Then company is going to use the machine for 35,000 units. And then the company is going to use it for 25,000 units. So simple as that, this 10% remains the same, 10%, 10%, it remains the same. Rather than going all the way, we can copy paste over here, 10% remains the same. And the formula will also remain the same. And you can see that in the first year, 4,000, second year, 6,000, 3,500 and 2,500. In order to calculate the accumulated depreciation, very easily we can do for the first year, because there is no previous year, so 4,000 will be there. After 4,000, we need to add up the last depreciation, this depreciation plus this depreciation, so 10,000. Then we need to add up this depreciation plus this depreciation is this amount. Then we need to add this value to this value. It is going to give us 16,000. So you can see that because we started the question with 16,000, how you get the idea why we started this question with 16,000. So original cost was 18 minus salvage value was 2,000, so 16,000. So if how to calculate the net book value? The net book value is very easy to calculate, again because we started it with the total cost is 18,000. So 18,000 we are simply going to put over here, 18,000 minus the accumulated depreciation, 14,000. We will keep on going it like this. So we will paste it over here, 8,000. We will keep on going like this, 4,500, again 2,000. So you can see at the end of this useful life, because we started the calculating it with 18,000, we are getting 2,000 at the end. If we start it over here with 16,000, you will get 0 over here. Let's try to do with 16,000. So 16,000. So if we drop it over here, if we drag it over here, if we drag it over here, 0. So it depends upon you that you want to start in the formula bar in top. You can see that if we start with 16,000 for this method, at the end we will get 0. But if we start with 18,000, why we are starting with 18,000? Because we want to show that at the end of its useful life, we have the scrap value. We are showing over here the scrap value, which is 2,000. So these are the 5 different methods to calculate the depreciation on the property, plant and equipment, or we also call it allocation or expense matching. You can also refer it to that we are putting the expense related to that period in our income statement, taking it out from the balance sheet. So these are the 5 different methods to calculate the depreciation amount and the value, net book value of the property, plant and equipment in the balance sheet. I hope so that the things are clear. Let's go back to our slide and let's try to read it from our slide again. So you can see over here the straight line method, which is in front of you, exactly the same formula. And in the straight line method, you can see that when we are calculating the depreciation, we are calculating the depreciation on the initial amount. So when we are calculating it initial amount, the total depreciation amount remains the same. That is why we call it straight line method. We already covered all these things. So I'm just going to skip these things and going to give you some chance to review these so that you can come up with the questions. And we are going to discuss your question at the end. Some drawbacks of the straight line method. The first drawback of the straight line method is that it assumes that the depreciation in early year is identical to the depreciation in the later years, which is actually not true, because in the early years of the plant or machine, the depreciation is less as compared to the later years. Second drawback of this straight line method is straight line method yields an increasing bias in the asset rate of return pattern over time, which means that the asset which we are using is going to give us the same return in the first year and the last year, which is again actually not true, because most of the time the assets, when we buy them, they give us more return, means they produce more as compared to the later years of their life. So these are some of the drawbacks of the straight line method. Then this is the double declining method. In the double declining method, simply the rate which we calculated in the straight line method, we are simply going to multiply it by 2. So it becomes a double declining method. But because it is declining method, it means that the opening balance and the closing balance will be the same, which means that in the straight line method, 16,000 depreciable amount will remain the same for all 4, 5 or up to 20 years. But in the double declining method, the depreciable amount will keep on changing. Every year we will be calculating the depreciation expense, and we will be reducing the depreciable amount by that depreciation expense and recording it as our net book value. Next year we are going to use the same net book value, or the last year's closing balance of the net book value will become the opening balance of the depreciable amount. So that's why we call it double declining method. Double declining, we call it because it is double the rate of the straight line method, and declining because in this method the depreciation expense is decreasing every year. Then comes, you can see over here, units of production method. I already shared with you the formula. Unit of production method is cost minus salvage value divided by the total number of production. This method, sometimes total number of units produced, we put it over here. Sometimes we use total number of hours. So both means the same thing. The method will have no effect on it. The only difference it will make is that we are using different words to represent the life of the asset. Then comes valuing the natural resources, which we call it as depletion. And in this, whenever we calculate the value of the natural resources, then again the value of the natural resources is recorded at the total cost plus the exploration cost plus all those costs which incurred in order to make the natural resource available for us. And when we record the cost in our balance sheet, in our financial statement, then we record the cost after subtracting the accumulated depreciation or depletion. Now we will call the word depletion rather than depreciation, depletion. In this valuing natural resources, exactly the same method will be used which we use for the unit of activity method. You can see the formula in front of you. Cost minus salvage divided by total number of units capacity. It will give us the depletion rate. And this depletion rate we will put in the same unit of activity method schedule, and we will calculate the net book value for each year depreciation, and we will calculate the net book value and the expense for each year. So this was the depletion. We are going to discuss now intangible assets. And the intangible assets, as you guys already know, include goodwill, patents, copyrights, and other kind of assets which we cannot touch. These are non-current assets. Uh, these often provide exclusive rights or privileges. For example, the software copyrights. These have also a useful life. But these intangible assets are not recorded if it is our company, or if we are doing our business, and we have worked hard to create a logo or something. So that uh, it is not that asset. The intangible assets are recorded only once we are going to purchase them. But it depends upon business to business. So intangible assets, as you can also see, record it at the cost, including the purchase price, legal fees, and filing fees. When we are going to purchase uh, some kind of patents, copyrights, or goodwill, then we are going to record them. Otherwise, we usually don't record them. So intangible assets, search for unrecorded intangible assets or goodwill when we are analyzing them. By the way, on these intangible assets, we will be recording amortization. As we discussed previously, that depreciation is calculated on the property, plant, and equipment, or hard assets, and on the intangible assets, we calculate amortization. The method is exactly the same, but the words which we are going to use, the technical word for the allocation of the expense of the intangible assets is called amortization. So when we are analyzing these intangible assets or goodwill, we need to examine the periods that in which we purchase these intangible assets. We need to recognize the goodwill has a how what is the limited useful life of the goodwill, what are the benefits which we are going to get from these intangible assets. So these are the same things which we already discussed when we are understanding the depreciation methods. Thank you very much. This completes our chapter number 4. Next session, we will be having question answers. Thank you very much.